Stay tuned for Common Sense, where we will be discussing tips for the upcoming tax season. Welcome back to Common Sense, the monthly TV show here on Cable Channel 17 at the University of Rio Grande, in partnership with the Ohio Valley Bank, where we talk about current issues as they relate to both the business and banking industry here in Southern Ohio. Ryan, it's good to be back here on the show again this month.
It is. We missed you last month.
It is. Well, I'm sorry I couldn't make it, but we're back again, so we got the band back together.
We do.
That's good. Well, it's getting close to that time of the year that everybody is so happy to experience. It's just like Christmas. It comes once a year, but it's kind of like a reverse Christmas. It goes the other way usually, where it's tax season and we give our hard-earned money back to the government.
Yep.
So.
Yep. And we've got our guest today. I think he can provide a lot of insight and answer some questions for us with all the changes that we've had over the last year.
Right. So we talked a little bit last year.
Yep.
New tax laws went into effect for this upcoming tax year that we're in right now. So we're going to talk about a few of those different changes and see what the differences are maybe to now and what they were in the past.
Right.
So today we're going to be joined again by Tim Brumfield, and Tim is the Vice President of Loan Central and manager of the Gallipolis Office. And welcome back to the show here at Common Sense Time.
Welcome.
Tim.
Thank you for having me today.
All right.
Yep.
Well, good. Let's. Why don't you start out by telling our viewers and kind of reminding them again about what your roles are at the bank and what you do.
Okay. I manage our finance company, Loan Central, in the Gallipolis marketplace. And one of the services that we offer is income tax preparation. We have for over 20 years. Just a little bit about me personally. I'm born and raised Gallia native. I've been here all my life and been working in finance for about the last 25 years. So, but great to be with you guys again, and hopefully can share some insights with you.
Well, welcome back. We're anxious to learn about some of the changes, and I haven't filed my taxes yet. I'm a procrastinator, so maybe I can take advantage of some of what we talk about today. But
you still have time.
I still got plenty of time. Well, speaking of time, I think that's one thing that's probably stayed the same as last year. When is the deadline?
April the 15th this year. It's a Monday. So
okay.
Still got some time to get that filed and hopefully get your refund back, right?
Yeah, absolutely. Hopefully a refund. Yep. So with the deadlines and the timing of the taxes, we know you can start filing January 1st or 2nd. Is there a certain time of the year or a better time of the year to file for quicker processing of your returns?
Well, really, probably right now is not too bad of a time.
Okay.
You can file, as you said, you can file from pretty much early January right up through the deadline. But a lot of people file right at the beginning, and so with filing right at the beginning, especially if you're using a professional tax preparer, you may have problems getting in. With appointments and so forth, but now we're through probably one of the bigger rushes of the season, so things die down a little bit, and then probably 1st of April things will ramp back up as we get close to the deadline.
Yeah, it did, and with that, I know early on the government shutdown probably delayed some of the refunds to an extent. So,
right, to an extent,
and then just playing catch up now and getting everything back on track.
That's right.
Yep. So, as Brad mentioned, last year, we were under a completely different set of guidelines as what we are this year. So, how do you think the new tax laws are going to affect refunds this year?
Well, that's an interesting and a very good question because really there's kind of two issues at play. One of the reports I've heard nationally is that refunds might be down slightly, even though that we did have this tax cut and an overhaul really of the tax system. And I think in a lot of ways it's probably pretty positive. However, that may not translate into a larger refund because last February withholding tables were adjusted, and if a taxpayer had less withheld, they could have had several hundred or even thousands of dollars less withheld. And even with a nice tax cut, if you have a lot less withheld, you could have some surprises heading your way.
Yep.
And not in a positive way.
Right.
So that wasn't a raise that we all got?
No.
Now, see, my employer told me that was a raise. So it wasn't a raise. Okay.
I guess it depends on how you look at that.
Okay, all right.
Yeah, so yeah, you do have a little more disposable income on a weekly or month-to-month basis, possibly. And it's just not, and we talked at lunch, it's either, have it all deducted ahead of time,
Right.
And then maybe, hope for that to be a savings account at the end of the year.
Yeah,
or you can
there's different thoughts on that.
Yeah.
And I'm not going to, I can't necessarily say that one's right and one's wrong. In a lot of cases, it's a personal preference of, do you have more withheld through the year to get a larger refund, or do you have less withheld and then you have more money during the year to spend, and then maybe at the end of the year you have a very small refund, or maybe owe a little.
Yep.
Right.
Yep.
So the bottom line is, it is your money, and obviously, in a perfect world, the exact amount would be held on a biweekly or a monthly basis, however we're paid, to match exactly what our tax bill is going to be through the year.
That's right. That's right.
So the refund is essentially just our money that we're getting back.
Correct.
So we don't have use to it. We don't draw interest on it. We don't have the benefit of that money throughout the year.
That's right.
But it is just kind of a savings account.
Yep. So with the changes, I'm sure the forms have changed as well.
They have. I think you'll notice this year when you see the forms that they've been somewhat simplified. As a matter of fact, the regular 1040, the look of the Form 1040 that you're used to filing your income taxes on looks a lot different than it has in the past. And also some of the familiar schedules that you're used to seeing that accompany your tax return have changed. They're now numbered. The schedules are numbered 1 through 6. So we're seeing that instead of
Schedule E, Schedule
well,
C.
there's still some of those as well,
Okay.
but just some differences in that regard. There's also a lot of changes as far as what your deductions are that you're looking at. Standard deductions have went almost doubled. They went way up, but that's been somewhat offset because of personal exemption amounts that we used to be able to deduct each year based on the number of people listed on your tax return has went away. And so that's going to be something that a lot of people aren't used to. That's something totally new, that you're not looking to deduct exemption amounts anymore, but the standard deductions have gone up.
Right.
Yeah. And if you could, for the viewers, maybe just explain what the standard deduction is, if you could.
Okay. Sure. I can do this by comparison, I think would be the best way to do that. In the past, you would deduct your standard deduction based on your filing status, and in addition to that, you would deduct personal exemption amounts. And last year it was roughly $4,000 per person. And you would, last year for a married couple, for example, it was $12,700 was your standard deduction. The exemption amounts, the $4,000 per person, has been eliminated, and now this year, a married couple that's filing together would have a married filing jointly a standard deduction of $24,000. And so, for some that have many people in the family, that may be their standard deduction, or the amount that they can deduct off their taxable income, may have went down. For others that maybe don't have as many people in the family, they may be sitting in better stead as far as that goes. So that's one of the major changes, is just in how we're able to deduct with standard deductions and exemptions, because exemptions are no longer.
Right. So talking to an accountant recently, he suggested that this has kind of simplified the process to some extent because it's eliminated a lot of people from being able to itemize.
That's exactly right. That is exactly right. There's been a lot of changes in regards to itemization. For example, one of the good examples I can think of is the traveling worker, someone who in the past has deducted mileage, has deducted meals, lodging expense, because maybe they're traveling 3 states away for a temporary job, and then maybe next month they're in a different state working. those employee business expenses that used to be filed in connection with the Schedule A, with the itemized deductions, do not exist any longer. And also there's limitations on mortgage interest that didn't previously exist. So if you're not buying, building, or substantially improving your home with a mortgage loan, if you're just doing, say, a consolidation of debt, that interest is no longer deductible for your mortgage interest. So those things are causing, as you said, itemizations to show up a lot less.
Right.
Okay. And one thing I think did increase this year is the child tax credit.
That's correct. That's correct.
Increased slightly, maybe.
Well, it doubled.
Okay.
For children that are under 17, on your tax return, you'll have a nice little present there of, instead of getting a $1,000 tax credit, you're going to see a $2,000 tax credit. And in addition to that, also folks that are in your home that are 17 or older, previously there was no tax credit available for those people listed on your return. You did get an exemption, but there was no credit. Now there is up to a $500, what they call family credit, for each person that's 17 or older that's on your return. So that can go to nullify some of your tax.
Okay. That's interesting. So let's talk a little bit about Loan Central. And we know that you do tax loans.
That's right.
But do you also do tax preparation without loans?
Absolutely.
Okay.
Absolutely. We offer a wide variety of products. You know, we realize some people would like to take advantage of our loan program and basically, instead of waiting for the IRS to send the refund back to them, if they can, maybe they have a need of, maybe there's something on sale they want to buy now and they don't want that to get away, or maybe they're looking to buy a car or something and they don't want the deal to go away, then we're there for that. But also, if you're someone that just needs to get your taxes done and you really don't have a need of a loan, then yes, we can take care of that need as well.
Okay, that's good. And your typical clients, do you work with individuals, families, businesses?
Individuals and families.
Okay, primarily.
Not corporate, no,
okay.
Business. So
yep.
only in so much of an individual would have a sole proprietorship.
Okay.
We would deal with them, but yeah.
Yep. Okay. So I guess, we could maybe give some advice from you on if someone's looking for help to get their taxes filed. What advice would you give to them, especially with the changes?
Well, I think you would, especially with the changes, I think you would want someone that you feel pretty comfortable with, that's well-versed in the laws, someone that has some experience. A lot of times people will try to, and maybe they don't seek out any assistance, they'll try to do it themselves. And for a lot of folks, that's probably okay. They probably can get through it and get the best deal for themselves or for their family. On the other hand, it never hurts to seek out someone with some experience, because there's a lot of things that do change. There's a lot of things that are somewhat complicated. We may have an understanding of a little bit of the concept, but maybe we don't understand all the details behind some of the credits or deductions of what we can exactly do. So you might want to seek out someone there that can help you, give you some advice before you would do that. But I would recommend someone that's been around a while and has some experience.
Okay.
What are some of those extenuating circumstances that an individual might have in their life when it's probably a good idea to see a tax preparer? I know they talk about, you've mentioned mortgages, medical, different things like that.
If you have something out of the norm that would happen within a year, something that you don't deal with every year. If it's just a tax return where maybe you have a job, you get a W-2 every year, and it's no more complicated than that, you may be able to handle that fine. You may be able to handle that with no assistance. But say, for example, you have a situation where you have a child that's starting college.
Okay.
That might be an example where you might want to look into discussing with a professional what credits would be available to you. A situation maybe where you have a property sale. If you sell your main home, or if you maybe have a second home and you sell it, that might be a good time, to consult a tax professional about, what you might need to do.
Right. Okay. And sometimes if we have a big medical event in our life, have a lot of out-of-pocket medical expenses,
right,
those can also qualify as...
Right. Medical expenses that are paid can be written off on a Schedule A as an itemized deduction, but you do have to meet certain
right.
standards. With the standards that are set, it would have to be something pretty major that you've had a lot of out-of-pocket expense.
Right. But all of those things, such as medical expenses that occur in 1 year, along with purchases or mortgage interest, along with charitable contributions, along all those things do add up.
That's
quickly,
true. That's
and they
true.
can get you to that 22,000.
And it would never hurt.
Threshold.
It would never hurt to consult a professional about, am I thinking about this the right way? Right. Can I do this? Is this allowable? Is this something that's going to get me in hot water with the IRS?
Right.
I've got a question that it's not on our list here, but about minors filing taxes. For example, my daughter, she's had a couple jobs, summer jobs, and during school and whatnot. So they would file the same way that you or I would file.
You would want to make sure that you're talking about if your daughter's still living at home with you and either under age 19 or still a student, even if she would be 19 or older and still a student. Chances are very good she's going to file the way we are, except she's not going to claim herself on her tax return because you're providing for her support. You would want her to be your dependent on your tax return. So you would want to make sure that if she would do that she would file her own return, not claiming herself.
Okay.
Okay.
Yep, that makes sense. So I know when you think about IRS and you think about getting audited and you think about all the fun stuff that would go along with that.
Yes.
So if I have receipts or if I have things that prove my expenses throughout the year, how long should I, as an individual, hold on to those?
Typically, there's a 3-year window. So, here we are. We're in 2019, and we're filing 2018 taxes that are due here on April the 15th, as we said earlier. You're probably going to want to look at hanging on to your 2018 materials until April of 2022.
Okay.
So that, just in general, that would be the best way to answer. That's a three-year window.
Okay.
Yeah, I just archived some of my reports and papers the other day from when I had my taxes done, and I went back and I noticed there were tax returns from 1992, 1993. So very interesting. If you go back and look at yourself, 25, 30 years ago, it's just a fun comparison.
You can keep those for nostalgia.
That's right. But all the receipts and stuff, you could go ahead and.
Yes.
But it's good. Probably not a bad idea to keep the actual returns.
If you'd like to, but I mean, usually that's.
But it's not necessary.
No, not with it being that far back. No.
It's just interesting information.
Yeah, it's funny you say that because we've got a cabinet in the filing cabinet that's just tax returns. Tax returns.
Sometimes those need to be flushed out. That's right.
So I guess if we could circle back around to, I know we talked about some of the changes and some of the new laws and whatnot, but for someone that's just going to someone to have their taxes done, what should they take with them?
You would want to make sure that, of course, you bring your Social Security cards. You'd want to bring your ID.
Okay.
You'd want to bring Social Security cards for all of your dependents that you intend to claim, and also your W-2s, any 1099s that you might have received, and then also if you're self-employed, your records that you would have from your self-employment business. Those are all things that a tax preparer is going to need to assess your situation.
Okay. And just to follow up on the how long to keep your material, maybe you can answer it. For businesses as well, that 3-year.
Right,
keeping it for 3 years.
For a sole proprietorship, yes, because That's the Schedule C is included on your 1040, so that it would have the same requirements there. You'd want to hold on to it that length of time, the 3-year period.
Okay. Yeah. So married couples, we haven't talked about that, and the differences between filing married or filing jointly. Can you talk a little bit about that? And
Sure.
maybe some of the advantages, disadvantages.
That's unique to the situation that you'd be presented with. For a lot of people, married filing a joint return is probably the best way to go. However, in some instances, married filing a separate return can be beneficial. I think especially here in doing a lot of Ohio returns, a lot of times it can be better in Ohio if you look at filing separately versus filing jointly. And it's mainly due to a benefit that you pick up in doing the Ohio return. One thing people may not be aware of, if you file jointly on your federal return, then you're required to file jointly on your Ohio return as well. And if you file separately, then you're also required to file separately on your Ohio return.
Didn't know that.
But that's something, again, for the viewers. I mean, if we work with somebody like you as a professional, you can compare those by simply clicking one box and then clicking the other and comparing.
That's correct.
What the output's going to be.
It's that's something that's pretty standard
Right.
that we look at, just to make sure that we're not missing anything for you to try to get the best deal that we can for you.
Right.
Yeah. And I know we mentioned dependents earlier. Maybe take a minute and explain what or who can be claimed as a dependent.
Okay.
Kind of define that for us.
Well, there's a couple different ways we can look at this. I mean, for most people, if you're talking about, say, a child in your home, there's 5 tests that go into whether or not someone can be your dependent. There's an age test, which generally they're under 19 years of age. They can be, if they're a student still and they happen to be 19 or over, they need to be under 24. Or they can be any age and permanently and totally disabled. So that's one test is the age test. There's also a residency test. They have a requirement they need to live with you. A relationship test. Also a test that they don't provide more than half of their own support. That's one of the things where, in talking about your daughter filing her return, obviously with her living with you, you're probably paying the mortgage and you're buying the groceries and the utilities and so forth. So she's not providing more than half her own support. And then the other test is that the dependent is not filing a joint tax return with a spouse.
Okay.
And that they can do that as long as the only reason that they're filing is to get back tax they paid in. But those are the 5 tests, and if you meet all those requirements, then you have a dependent. That would be a qualifying child.
Okay. And pets are not included?
Pets are not allowed.
Okay.
No Social Security numbers for the pets.
Okay. I know at lunch we talked a few minutes about the state portion of the tax returns. And there's really been no changes with that. It's stayed fairly...
Talking about the Ohio tax return, there's really not a lot of changes with Ohio. One thing we talked about, and maybe our viewers aren't aware of, and this is not really a new deduction. It's been around 6 to 8 years, somewhere in that neighborhood. But it's called a small business deduction. And if you have a business where you're deemed self-employed and you report that on your federal return, and you have a profit, you can up to, well, of course there's limits, but up to the limit you can deduct that 100% under the small business deduction on your Ohio return, which can be, that's a significant deduction. And I mean, that's one that I think a lot of times gets overlooked because it's, even though I wouldn't say it's new anymore, it's newer. So it's been around a few years, but not maybe as long as some of the other deductions.
And would that include, say someone has a W-2 job and they just have a side business?
Yes.
And that
they can deduct the portion that would be considered self-employment.
Okay.
As long as they have a profit from it.
Right.
Okay.
Well, that's interesting. That's another incentive to do business in Ohio.
It is. Absolutely.
It truly is.
So I know we've got a couple minutes left. The half hour usually flies by. Is there anything that we haven't talked about that you would like to make sure we cover?
Well, I would just say that, there's been a lot of talk in the media about refunds and maybe that they've gone down a little bit and that there's a lot of changes, and probably maybe some advice that I could give would be, if you're dissatisfied maybe with how this year turns out, because this is year one of kind of a new system of new tax laws, talk with your folks in your HR department that withhold your taxes. If you're not satisfied with what happened this year, maybe adjust your withholdings. And it could be that, maybe you're one of those folks, maybe you had too much withheld. And you can adjust it down, or maybe if you didn't have enough tax withheld and you got surprised in a bad way this year, it's still early enough in the year. There's still several months to go. You can get that adjusted and have them take a little bit more out each week, and then maybe next year you can turn your frown upside down.
Sure. Sure, and it's one of those. It's really a preference thing.
Yes.
Do you want more money on a weekly basis, or do you want more money at the end of the year?
Right. That's usually the case, and I've had clients that some are on one side of the fence, others are on the other side.
Yep.
So.
Okay.
Right. And we've just got another minute and a half or so, but you guys do the loan with Loan Central. You do the quick, the little loans for the tax refund. Are there competitive products out there on the market that consumers should be aware of?
Well, there are other companies do offer advances against refunds as well.
But some of those can be risky, or?
Well, a lot of times I think probably the differences are maybe how much that they might be willing to advance you against your refund.
Okay.
Our product, if you're a new customer, will advance. If you qualify for the loan, we'll do $2,000. If you're a returning customer, we'll do $3,000 if you have enough refund.
Right. That's good.
Well, very good information, I can tell you.
It
is that time, and we still, if you haven't done it, you still got a month or so.
That's right.
To get everything in order. I think mine's scheduled for the 18th, so hope I don't get surprised.
That's right. Mine's finished, and I'm glad it's done. Still in process, so waiting.
Yeah. Well, Tim, we really appreciate it. I know our time is running out today. Hopefully we'll be back again next year, and we can say how smooth this process has went.
That would be great. Thanks for having me back today.
Appreciate it.
Well, again, yes, thank you very much for joining us, Tim. And for Common Sense, I'm Brad Bapst.
I'm Ryan Mapes.
And we'll see you next month.